Good afternoon and welcome to today's AEI virtual event. Will massive Federal Reserve stimulus prevent a deflationary spiral, or could it spark a big increase in inflation? My name is Paul Kupiec. I'm an economist and an AEI resident scholar. Central banks are undertaking new stimulus programs with a scope and scale unimaginable a few months ago. The Federal Reserve, the Bank of Japan, and the European Central Bank initiated new programs to purchase securities and open lending facilities to support businesses in the hopes of preventing a global COVID-19 deflation. Will these policies spark recovery, or could the massive monetary stimulus underway eventually backfire and trigger inflation? History includes many episodes where government deficit spending financed by central banks resulted in destructive bouts of inflation. Before today's speakers dive into the details, I want to set the stage by providing a quick, simplistic overview of the process that creates our money supply. The Federal Reserve creates money by purchasing U.S. Treasury, securities, and other government-guaranteed securities. It pays for them by increasing bank reserve accounts at the Fed. Bank reserves are central bank money. They are nothing more than electronic entries in a Federal Reserve ledger, but they are the core ingredient in the recipe for creating money that is used to settle all transactions in America and many offshore transactions as well. Reserves are liabilities of the Fed, but they're assets for the banks that own them. In our fractional reserve banking systems, banks themselves can expand the money supply by making loans to consumers and businesses. Bank loans create new customer transaction account balances, and it is these transaction account balances that comprise the largest part of the money supply. Bank transaction balances must be backed by fractional amounts of reserves held at the Fed. The Fed sets a minimum reserve fraction, but banks can and do hold excess reserves for a variety of reasons. The Fed uses a host of policy tools to try to control the volume of transaction account balances banks will create using the reserve balances they hold at the Fed. The Fed policy levers in part determine the magnitude of what economic textbooks call the money multiplier. Fed policy levers include minimum reserve requirements, the interest rate the Fed pays on bank reserve balances, minimum bank capital and liquidity rules, bank supervisory rules and guidance, and the Fed's bully pulpit. Following the 2008 financial crisis, the Fed and other central banks pushed policy rates to the zero lower bound. The ECB, the Bank of Japan, and other European central banks subsequently pushed policy rates below zero. When historically low interest rates alone did not stimulate growth, central banks undertook massive quantitative easing operations, buying up government-guaranteed securities, and in some cases, even equities, increasing the size of central bank balance sheets and pushing bank reserves to unprecedented levels. The liquidity created to combat the 2008 financial crisis and subsequent Euro member debt crisis gave rise to inflationary concerns, but inflation never materialized, at least not according to common measures of inflation. Central banks never achieved their stable 2% non-accelerating inflation targets, even though policy rates remained negative or below zero for years. While the surge in central bank liquidity did not cause consumer price inflation, it was associated with a substantial surge in financial asset prices and a recovery in residential real estate valuations in many parts of the country. It is worth noting that the Federal Reserve's May 2020 Financial Stability Report lists elevated asset prices as a potential stability risk going forward. At the onset of the coronavirus recession, no central bank had successfully unwound their special financial crisis policies, reversed the growth in their balance sheets, or reinstituted their normal pre-crisis monetary policy operations. Indeed, the Federal Reserve began a new round of balance sheet growth months before the virus struck, when in September 2019, it initiated new rounds of quantitative easing to calm volatility in the repo markets. Once coronavirus hit, the Fed acted decisively. It lowered the target federal funds rate and the discount rate by 150 basis points, slashed reserve requirements to zero, announced a new quantitative easing operation. It also opened 3 new special funding facilities for commercial paper, primary dealers, and money market funds. It set up temporary dollar swap and repo facilities to allow foreign central banks easy access to US dollars so they could support the needs of their domestic businesses abroad. After Congress passed the CARES Act, the Fed established special funding facilities to provide direct support to businesses and municipalities. Before the 2008 financial crisis, the Fed owned $890 billion in assets. The 2008 financial crisis response increased the Fed's balance sheet to $4.5 trillion in assets, before tapering off to about $3.8 trillion in August 2019, the low point before the Fed began a new QE operation to calm turmoil in the repo markets. After the COVID-19 measures are fully implemented, the Fed's balance sheet could grow as large as $10 trillion, roughly 50% of US GDP. Bank of Japan and the Japanese government also responded aggressively to both the 2008 financial crisis and more recently to the COVID-19 pandemic. By 2018, the Bank of Japan's assets equaled 100% of Japan's GDP, and the new coronavirus stimulus measures will further expand its balance sheet. The ECB actions roughly mirrored those of the Fed of the BOJ and the BOJ, although the ECB's actions thus far in response to coronavirus have been less aggressive. Is this new tsunami of deficit spending and central bank liquidity the medicine needed to counteract economic damage from the coronavirus pandemic? Do central banks have the tools and skills needed to manage the money multiplier so that these stimulus measures mitigate deflationary pressures and keep the risk of inflation in check? Could central bank missteps wind up creating too much money, facing reduced real GDP, the classic recipe for a monetary inflation? These are hard questions to answer. Luckily, I'm not going to answer them. I have three distinguished economists here today who are joining us, and they're going to discuss these important issues and answer them for us. So please allow me to introduce today's guests in the order in which they will be speaking. Speaking first will be Professor Richard Sylla. Professor Sylla is Professor Emeritus of Economics at the New York University Stern School of Business, where he was Henry Kaufman Professor of the History of Financial Institutions and Markets. Dr. Sylla is a research associate at the National Bureau of Economic Research, a fellow of the Cliometric Society, and a fellow of the American Academy of Arts and Science. Professor Sylla earned his PhD at Harvard University. He's a prolific author. He's written 9 books and an impressive collection of articles, essays, and reviews on business, economic, and financial history. He served as editor of the Journal of Economic History and was chairman of the Board of Trustees of the Cliometric Society, the Association of Quantitative Economic Historians. He served as the president of the Economic History Association and president of the Business History Conference, the leading professional association of business historians. Dr. Sylla is the current chairman of the board of the trustees of the Museum of American Finance, a Smithsonian affiliate museum located at 48 Wall Street in New York City. Speaking second will be Professor Thomas R. Savings. Thomas is the director of the Private Enterprise Research Center and University Distinguished Professor of Economics at Texas A&M University. He earned his PhD from the University of Chicago. In addition to his position at Texas A&M, he held faculty positions at the University of Washington in Seattle and Michigan State University. Professor Savings has published in all major US economic journals and is the author of several books, including 2 books on monetary theory and policy. His editorials have appeared in the New York Times, the LA Times, the Washington Post, and the Wall Street Journal. President Clinton appointed Professor Savings as a public trustee of the Social Security and Medicare trust funds. Under President Bush, he served 2 terms on the Bipartisan President's Commission to Strengthen Social Security. He has served as the president of the Western Economic Association, the Southern Economic Association, and the Association of Private Enterprise Education. Speaking third will be Professor Gerald Dwyer. Jerry is a professor and BB&T scholar at Clemson University. He is also an adjunct scholar at the Cato Institute and a research associate at the Center for Applied Microeconomic Analysis at Australian National University. Professor Dwyer served as director of the Center for Financial Innovation and Stability and vice president at the Federal Reserve Bank of Atlanta from 1997 to 2012. Prior to his Federal Reserve service, he was a professor of economics at Clemson University. Professor Dwyer's research has appeared in leading economic and finance journals, books, and publications of the Federal Reserve Banks of Atlanta and St. Louis. He serves on the editorial boards of the Journal of Financial Stability, Economic Inquiry, and Finance Research Letters. He's a past president and member of the executive committee of the Association of Private Enterprise Education. He was also a founding member of the Society for Nonlinear Dynamics and Econometrics, an organization for which he served as president and treasurer, and which honored him by creating the Gerald P. Dwyer Prize in Financial Econometrics. Jerry earned his PhD at the University of Chicago. So you can see we have a great trio of very distinguished economists here, and I'm going to turn the Zoom podium over to Professor Silla.
Thank you, Paul. It's good to be with my colleagues here today. For my remarks, I want to think about, as you mentioned, I'm a financial and economic historian. I want to focus on the idea of wars, because wars in US history have produced some outcomes like we're seeing now. And other people have used the war analogy. We're engaged in a war on a virus, a war against an invisible enemy. The analogy, I think, is interesting. It's not perfect. I would say it's rather imperfect. The war analogy, I think, is relevant because it has some similarities to wars. Like traditional wars, this one will likely last longer than people expect at the beginning of it. Most wars last longer than people expect when they begin. A second thing is that the role of government goes up a great deal in a war. A third thing I would mention is that government spending, of course, goes up on war material and labor resources. I would say that certainly we're spending more on materials. Think of all the money spent on ventilators and testing kits and things like that. A lot of spending there, but we're not spending so much on people. We're not drafting people into the army of the war on virus, except perhaps our healthcare workers and some of our grocery store clerks and so on, that Amazon workers, I guess, have increased a lot in the war. So there's certain aspects, but in general, the labor market hasn't been certainly it's not been tightened by this. It's almost the opposite. Number 4, I would say, is that in wars there are winners and losers. We're talking about economic sectors now, and we know who the big losers are. The travel and entertainment business. We've heard about nobody's going to hotels, people aren't going to restaurants, sports events, airlines, cruise ships, and all that. These seem to be the losers so far in this war. And it's because people have been told to stay home and not go to these things. I would say that the winners, as far as I can tell, and I keep as an economist, I keep an eye cocked on Wall Street. The winners seem to be big corporations with strong balance sheets and limited competition. They've been going up on Wall Street. Another, I think, aspect of our war is there's talk about what sort of change will this make. I think right now nobody knows how our institutions and society will change as a result of this war against the virus, but we'll have to wait and see on that. What are the differences? Here's where the analogy breaks down a little bit. Unlike in past wars, labor markets, as I mentioned, are not tightening, and we don't see any great signs of inflation so far. In fact, there are general fears of deflation. The Business Week magazine arrived in my mailbox yesterday, and the thing that caught my eye right away the day before our meeting here today was one of the articles is titled "Deflation Stalks the U.S." And that's not the only place I've seen fears of deflation breaking out. And there's some other pundits are saying the problem right now is deflation. We better be careful about that. So another difference between now and the usual war is that in the case of a usual war, a recession occurs at the end of the war. The demobilization, economic slowdowns. In this particular war, the recession is starting at the beginning of the war. that's kind of unusual. So there are some differences in past wars and the current war, if such it be, but there are some similarities as well. So let me now turn to my the historical points about the wars in U.S. history, and major wars. I'm not going to talk about the Spanish-American War or the Mexican War or even the Korean War, but there were a number of major wars in U.S. history, and we economic and financial historians know a bit about what happened to price levels in those wars. That's what we're really talking about today, price levels. What's the outlook for the price level? And we also know a bit about what was behind the changes in price levels. So first, let me just mention, and there's some similarity to these wars. If I had to just generalize what I'm about to say in a little more detail, in most of these major wars, the price level sort of doubles, depending on whether you're looking at consumer prices or wholesale prices. In major wars, sometimes it's more, sometimes it might be a little bit less, but a sort of fact from, I guess I would say, 6 major wars in U.S. history is that you can usually expect the price level to roughly double. The first war I'll talk about is the War of Independence, of course, the American Revolution, which actually took place from 1775 to 1783. What we know about that is that the whole consumer price level approximately doubled. The wholesale price level approximately tripled. The rate of inflation was roughly speaking 12 to 13% a year at its height in the years 1775 to 1780. And we know behind that there was a large monetary expansion. The national government, wasn't quite the federal government yet, but under the Articles of Confederation, issued paper money, fiat paper money, even though it said on it, it was exchangeable for silver dollars. So the government had no silver dollars to back its paper money. These were called continental currency, and a couple $100 million of continental currency were issued during the war. Remember, the United States only had 2 or 3 million people at the time. So this was a huge monetary expansion. At the same time, the state governments, the old colonies, the state governments like Massachusetts, New York, Virginia, South Carolina, they issued their own paper currency. So you had continental currency and state paper money. This money wasn't really backed by anything. And there were the huge inflation I described, sort of 12, 13, 14% a year, with a doubling, in the case of wholesale prices, tripling of the price level. The next major war is the War of 1812, which basically lasted from 1812 to 1814. Prices didn't go up quite so much in that fairly short war. I think the CPI went up about 34%. The wholesale price level went up 44%, but it was sort of a short war. So the inflation rate was actually about 10% a year. And the source of the monetary expansion basically came from the Treasury issuing something called Treasury notes. It These were kind of round denomination, $100 denominations were popular as a sort of currency for which the government used it to pay war suppliers. Our credit wasn't very good in the War of 1812, and so the government had to turn to a sort of different form of paper money called Treasury notes, and they issued a lot of those, and the result was it's a good thing the war didn't last too long, but while it did, the inflation rate was about 10% a year. The Civil War, 1861 to 65, 1860 being the last peace year. The CPI doubled in the Civil War from 1860 to 65. The wholesale price index doubled. The inflation rate was something like 12 to 14% a year. And there were 2 sources of monetary expansion. One was the greenbacks. The government, as in the American Revolution, the government issued a paper currency that was a fiat currency. It wasn't backed then, and it issued rather large, $300 or $400 million of this fiat paper greenback currency, but that didn't serve all the needs of the government. So it created a banking system. Paul, you mentioned that the Fed creates money by buying government bonds. What happened in the American Civil War is that the Lincoln administration and Congress passed the National Currency and Banking Acts, which created the national banks that are still with us. And one of the obligations of the national banks was to buy bonds from the government. So it was similar to what you described, Paul, and what how the Fed creates money. Anyway, these national banks had to buy government bonds. The two sources together, the currency and the liabilities created by the new national banks, led to this doubling of the price level. The annual rate of inflation was about 12–14% a year. And the war lasted 4 or 5 years. And at the end of it, prices were approximately twice as high as at the start. Next major war, World War I. 1913 to 20, the war began in 1914. 1913 is the last year, and the war ended. Usually they say the war was 1914 to 1918, but in fact, some of the financial effects of it continued into 1919 and 1920. Again, the consumer price index in the United States doubled. The wholesale price index more than doubled. The sort of annualized inflation rate of those indexes was about 10 to 12% a year over those 7 years. That's a pretty long period. And they've made source of increased money now. The Federal Reserve was created in 1913, and the Federal Reserve banks actually opened at the end of 1914. And they were sort of immediately enlisted in the war effort to sell to create liquidity for the banking system so that the banks could buy government bonds and the customers of banks could buy government bonds. That was the characteristic of World War I. The Fed didn't buy so many securities itself. It just created the credit so the banks could buy the securities and their customers could buy the securities. And when there were all these war drives going on, getting people for patriotic reasons, as in most wars, to lend money to the government. And so the price level doubled, 10 to 12% a year inflation for 7 years. World War II, number 5 in my list of major wars. The whole war era was like 1939 when it began in Europe to 1948. A lot of people think it ended in 1945, which it did as a war. But during the war, the government had a lot of wage and price controls. And it started taking those off at the end of the war. So some of the price level increase, in fact, a good deal of it because of wage and price controls, came after the war was over in the 1946, 47, 48. I remember when I was a kid, my father had purchased a 1941 Chevrolet, and I saw the bill of sale. This will eat your heart out. The brand new Chevrolet in 1941 cost $900. And in 1947, there were no 42 to 46 Chevrolets, but in 1947, a very similar car came out made by General Motors, and it cost twice as much. It cost about $1,700–$1,800. So what was the overall results? The CPI in World War II, remember this is up to 1948 after removal of wage and price controls, the CPI went up 1.7 times, about 70%. The wholesale price index doubled, as it did in other wars. The overall rate of inflation in that war was about 6 to 8% a year. How was it financed? Well, again, the Federal Reserve was conscripted into the war effort. And what it did in World War II, a little different from World War I, it actually pegged rates on government bonds with the idea that if the rates got any higher than the Fed's peg, the Fed would buy those securities. So it was more like what you described earlier, Paul. The Fed was just buying the government bonds, and it bought a lot of Treasury securities. I think the rates on Treasury bills were pegged at 0.3%, sort of today's level of interest rates. And nobody wanted to buy Treasury bills at 0.3% in World War II. So almost all the Treasury bills issued in the war were bought by the Fed. But a lot of government bonds were bought by banks. I'll have one last war before I yield the floor to my colleagues. I'm going to say the Vietnam War, which was also associated with a war on poverty and building of the Great Society. This lasted for quite a long time. I think the Vietnam War heated up in the mid-1960s and was over by the mid-70s, but the inflation continued afterwards. A lot of us, I think, I'm looking at my colleagues, we probably are old enough to remember this. And Paul, you might be too young, but I think my colleagues will remember it, the 1970s. And this in some ways, you know, the war on poverty, the war in Vietnam, it might have been our greatest war in the sense that from 1965 to 1981 or 1982, the price level tripled. And the CPI tripled, the wholesale price index tripled. And for that period of 16, 17 years, we had an average inflation of between 6 and 7% a year. For the average inflation at 6 or 7% a year for such a long time is just what you need to get the price level to triple. We know pretty much now that the Federal Reserve was behind the money creation. A lot of us studied it when we were students or young professors. And the Fed, for whatever reasons, I mean, we look back now and say it had the wrong policy, but it basically created the liquidity to allow prices to triple over 17 years of our lives. All right, and let's come to my last part, and that's the virus war we're in right now. Should we be worrying about inflation or deflation? It seems that macroeconomists for the last 30, 40 years don't look at the things they were looking at when I was a young man. That is, they look at the Federal Reserve and they look at its interest rate. The Federal Reserve talks about interest rates, but you know, when I was a grad student in the 1960s, Milton Friedman had just come out with the monetary history of the U.S. and he taught us that we ought to look at the monetary aggregates. You don't look so much at the monetary aggregates today because the Fed doesn't talk about them much, and they're not the subject of much attention as they were in the 1970s when we were having that high inflation. But there is a group in New York called the Center for Financial Stability that rides herd on our monetary aggregates. And their latest report I've seen, which came out a week or so ago, and they were talking about what's going on through April, they reported that something rather shocking, that our monetary aggregates have hit like an all-time high, and that the year-over-year rate of increase of these aggregates, M1, we used to talk about that back in the 60s and 70s, M1, in the year ending April, and most of the increase came in February, March, and April, the M1 money supply went up 29.9%. Whereas in the previous year, up to April 2019, it was 2.7%. M2, which is the what Milton Friedman used to tell us to look at, sort of the base and bank demand and savings deposits, that rose in year over year to April 17.8%. M3, they have some broader measures, 16.8%. A narrow version of M4, which includes things like money market funds and commercial paper, rose 16.5%. And the broadest version that includes some treasury securities, the treasury bills the Fed has been issuing, M4, this broad version of money, was 22%. In other words, as of now, for the last year, we've had like not just barely double digit, but very healthy double digit increases in our money supply. And these are huge changes, actually. They remind me of the kind of things we saw in earlier wars, but in some ways they're even greater. So, you know, in that sense, this is a lot like wartime, with a lot of government spending financed by money creation. So far, there's not a big sign of inflation, except perhaps in the stock market. And people are worried about deflation. Well, you know, I've just told you the facts, ma'am. I'm going to let my colleagues now tell you what all this means. So over to you, Jerry, or no, Tom, I guess. Thank you.
Thanks, Dick. Professor Savings, please.
Right. I think I'd like to, let's see if I can see. I've got to share this somehow. Yeah. Can't do it. Well, I've lost whatever I'm doing. Let me try to get back to where I was. All right. I was trying to see my slides, and what are we doing with them? I don't know.
Professor Savings, the share button at the bottom of the screen. If you run your...
I'm sorry. I've got, oh yeah, share screen. Got it. Okay. Got to do that. I'm screen sharing. Okay. All right. Now I can see what I'm doing. And what I would like to do is to show you a little bit about what's going on here and relate it to what we did with the last crisis. And we might even suggest that both of these financial crises are sign of government cause. One of them would have been forcing Fannie Mae and Freddie Mac to issue, to guarantee securities with subprime loans. And this one, shutting down the government. So we want to move on from that in a little bit and say what actually happened in what we're doing. Now I'm still trying to get this thing to move. Oh, there we are. Okay. Here we are. If you can see this, you're looking at 2008 on and asking yourself, what did we do last time? And how is there any message that what the Federal Reserve did last time that we can apply to this time, even though this is a different kind of a deal than we had then? But you can see very clearly if you can see this graph and see the upper blue line, how rapidly that went up without buying any treasuries. As a matter of fact, the Federal Reserve initially sold treasuries and bought other kinds of assets. And the other assets were because we were in a financial crisis, and only central banks can solve a financial crisis. Only central banks can make the currency elastic, which is what the Federal Reserve was designed to do. Central banks can flood the market with liquidity. And how do we do that? And we'll see how we do it. We just move on to the next one of these slides. I keep going too fast. Right there. Here's what we did. And this is what we're doing this time too. First, we have a lot of loans, repurchase agreements. This is how we're going to give the banks money. We're going to have to give the banks cash. We're going to have, and then we're going to, the commercial paper market disappeared because every money market fund, everyone wants liquidity. And by that, they don't want a money market fund. They want cash. And how do they get cash? They can only get it from the Federal Reserve. And so the Federal Reserve flooded the market with liquidity, as we would hope that they would. That was the idea, flood the market with liquidity, and that solves the problem you have. What happened? Excess reserves went way up. We've already talked about that. Dick talked about it. Excess reserves have gone, or certainly Paul did. Excess reserves have gone way up. But we did something that economists missed, because for 2 years after 2008, many, and I'm responsible for some of that, Alan Meltzer, other people, writing in the Wall Street Journal, warning people we were going to have huge inflation. We all missed something really important. The Federal Reserve started paying interest on reserves, and that changed the world. In fact, it's the only interest rate the Federal Reserve can actually determine. All the rest of it is market determined, it has nothing to do with the Fed. But that rate of interest is critical. And if you take a look at this graph, the spread between 1-year treasuries and the payment on excess reserves was negative throughout much of the expansion period of the Federal Reserve. And that negative rate meant that reserves were more profitable for banks to hold than anything else. If you had another graph here that would show you the share of commercial bank assets that were excess reserves, you would have seen them look just like this red line on this graph. What we did was neutralize all those reserves. Now they're sitting there. They were $2.7 trillion waiting to get into the economy to cause inflation. Never happened. Never happened. Now, and that in that area then between the crises, if I could just make this work, this gives you an idea about net assets. Suddenly, the important issue is Federal Reserve net assets, not gross assets. And all we've been talking about are gross assets. Suddenly, reserves are actually liabilities of the Fed. Why? Because they have to pay people to hold them. That's a real liability. And that liability affects, for example, the Treasury, because in one sense, the Treasury owns the Federal Reserve. They're the residual income recipient of the Federal Reserve. They just have non-voting common stock. And at one point in 2014, the Federal Reserve transferred almost $100 billion to the Treasury. The assets they were buying were yielding more than what they were paying on reserves. But then at the end of 2014, they decided that we're now going to try to get back what I used to call your grandfather's Federal Reserve. How are we going to do that? Well, we're going to, first, the interim period, the little gray line that you might be able to see on there are reserves. And you can see it's falling tremendously. In order for the money supply to grow, if the Federal Reserve's not injecting anything, the banks have to inject the money into the money supply. And how do they do it? They get rid of reserves. And you can see that line falling nicely. And then they get to their asset reduction because they decided, let's try to go back to our grandfather's Federal Reserve. They start selling assets. How's that going to work? Well, what has to happen for the money supply to grow so they can have their 2% inflation they would like to have, reserves have to fall even faster. And as you can see, they did that. And they did it for most of 2017 and 2018. But unfortunately, the Federal Reserve messed up on what they were doing with the payments on assets, on reserves. And you can see here in this little thing, the little blue line's the spread. And by the time you got to March 2019, reserves were paying more than market investments. And what was happening, reserves started to rise. And when reserves start to rise, the money supply stopped growing. And now you can't get rid of reserves because the Federal Reserve wasn't lowering the interest on reserves fast enough. And that caused them a lot of trouble. So now let's get to this current crisis. Let's try to get some idea about if I can just make this thing here, just to give us a little idea about some things we talk about the money supply. This starts from week 1 of September 2018, that's the blue line, and January 1, 2020. The little orange line is where we're going with COVID-19. The money supply, the M1 money supply rose 28% from January 1 to now. For the entire period of the simple 22 weeks of the 2008 liquidity crisis, it only rose 15%. What's going on? Well, we can see that right away. What's going on is people are desperate for liquidity, desperate for liquidity. If I can only find where I want to go here. Okay, here. You can see the two lines, they're sort of horizontal lines. That's Federal Reserve policy. The black line is market rates. You can see market rates falling. Why would they fall so fast? They fall so fast because every uncertainty, people are scared. When you're scared, what do you want? You want cash. And you're going to get rid of everything else. And what's the most reliable asset that's not cash? It's Treasury securities. Any other security is not as good as Treasury securities, is all you want is cash. And if everybody wants cash, what's going to happen to them? The prices of securities, they're going to rise. And even though the government is issuing huge amounts of them, the demand is increasing faster than that. And interest rates are falling through the floor. And that's what's really happened here. That's what's happened. And now the question is, what are we going to do? Well, the asset response is pretty simple. In this episode, we've increased assets of the Federal Reserve, 3.6 trillion. Well, I should say not this one. The left-hand side one is saying how much we increased assets in the 2008 crisis. We increased them 3.6 trillion, 387%, but over 6.25 years. In this crisis, we've increased assets of the Federal Reserve 69% in 4.75 months. It's a gigantic change. We're flooding the market with liquidity. And that flooding the market with liquidity is, this comes back to M1 growth again. And well, let's go back to where we are. In a traditional kind of arrangement, here we are with the Federal Reserve in two traditional liquidity crises. And one of them would have been Y2K. Y2K, everybody thought if you were a COBOL programmer, you got rich in 1999 because all those programs were written in COBOL and nobody knew COBOL anymore. It's a past language. So you got rich trying to get programs to work. The Federal Reserve, now these are small numbers, remember we're used to, when it had huge monetary liquidity operations, provide liquidity in case the whole economy shut down when January 1, 2000 happened. It didn't happen. And as you can see from the left-hand side of that graph, the whole thing went away. And it went away in 5 months, totally went away. They bought securities, they sold them back. Everything worked just fine. The next one was, of course, was 9/11. 9/11 was the next crisis that all of us have seen, 9/11. What happened was, first, the Trade Center had huge amounts of financial markets. But the second thing is people are scared. Uncertainty happens. When people get scared, what do? They get currency. And the Federal Reserve is the only people to make the currency elastic. And how do they do it? They go into money market. They go into the money market business. They made the commercial paper market in 2008. They're making the commercial paper market now. They're the same thing. They've got paycheck protection. They have, and primary dealer credit. They did a lot of that in 2008 because we've got Lehman Brothers, all those guys going under. The Federal Reserve was heavily involved. Those things went away very quickly, and they'll go away here very quickly. Once things start and people realize that this is ultimately going to be over, this demand for liquidity will go away. But until that happens, we are in a situation where the Federal Reserve is, and when it does get there, all those excess reserves are potential money. And that potential money is a real danger. And that's what the title of this is about. What's going to happen to all those reserves when the economy returns to equilibrium? And the Federal Reserve is going to have to either pay the banks to keep them. Now, what they've done in other liquidity crises, as we've just talked about, is that they expanded and they contracted in the same way. You know, those were shorter crises, but they contracted. Now, with interest on reserves, they don't have to contract ever. Now, you do have a problem there, right? If the assets that they're buying have low enough interest rates now, and if market rates go back up and they want to prevent the bank from lending the money, the interest on reserves is going to be above their assets and they'll have negative profits. Now, they can't get money from the Treasury because they don't have to. The central bank can't go bankrupt. So it'll be interesting to see what does happen. But I expect that they will sell a good bit of these assets that they've expanded just the way they've done in other short run crises. And in this one sense, this is a short run crisis, but it's unheard of for us. And that's the real issue here. We don't know what equilibrium is going to be like again. In fact, is the whole world going to be doing what we're doing right now? I don't think that's going to happen. Of course, you won't be able to build physical capital with Zoom. You'll actually someone will have to actually show up for work, and we'll see what that's going to happen. But I think that it will. And I know I'm interested to find out what Jerry's going to say, because I've seen the last piece that he's done, and it'll be interesting to see where he's going to go. But that's where I am. We handled this crisis before. The only thing that's different is we still have interest payments on reserves. We can still control how many reserves the banks are going to hold. And if we do it right, which the Federal Reserve didn't do when they were selling assets fast enough, but they can do it right. And if they do it right, they can control this. But they also can get rid of it because these are hopefully just like the other Y2K and 9/11, except they're bigger. And that's where I am.
Barry, you
Sure.
have the Zoom box.
Here we go. So what I'm going to say is complementary to what Tom says. I'll probably be marginally different in places. And then I'll talk more about going forward, what we might expect to see. I'll talk a little bit about what we might expect to see in the next year or two. Whoops. Come on. There we go. One of the things that happened at the start of this coronavirus was that, I'm trying to move a little box, sorry. The Fed created a bunch of facilities. And to be honest, when I read about it in the paper, I said, wow, this seems like, same thing over again. Commercial paper funding facility. I've heard of that. That was the financial crisis. The term asset-backed loan facility. Yep, I remember that. Money market loan liquidity facility. Yep, I remember that. Primary dealer credit facility. Oh, I remember that. In part, I actually thought, if what they think is this is a rerun of the financial crisis, it's really quite different. I knew that they thought different than that. I mean, the Federal Reserve can make mistakes, but there's no doubt there are smart people there. Come on. It's losing focus. And they actually did introduce various new things. They extended the money market liquidity facility and the commercial paper funding facility to include collateral, including municipal securities, because this time it's not really housing so much, but certainly it's affecting state and local governments in a dramatic way in terms of tax revenue and to some extent in terms of expenditures. They added a little later in the prior financial crisis, additional asset purchases of treasury securities and mortgage-backed securities. Including agency commercial mortgage-backed securities, because obviously this is going to be a problem for shopping centers and retail places in general. They added a bunch of new facilities. The primary market corporate credit facility. Actually, what the Fed's going to do is they're going to buy corporate bonds at issuance from select companies. And there's a secondary market corporate credit facility, and they're going to buy secondary market corporate credits and even selected ETFs, exchange traded funds. They're participating in the Paycheck Protection Program, PPP. Maybe that's easier to say. That's created by the CARES Act. They're providing term financing for SBA loans. There's the Main Street Lending Program, where what they're actually going to do is financial institutions, not just banks, are going to make loans to medium and small businesses, and then the Fed will primarily purchase the largest share of those funds. Then there's the municipal liquidity facility, which purchases eligible notes from cities, states, and counties when they're issued. So they're new issues, not secondary market. These are all new. In part, you'll see it later in a different slide. One of the things to realize about this is a lot of these things have terms of 3 or 4 years. They don't have a term of 6 months, which might be, or a year. And so a lot of these funds are going to remain on the Fed's balance sheet for not forever, but a significant period of time. So this is a graph. Actually, you can get this at the board, which is really nice of them because it's a real pain to do it yourself from experience. This is the liquidity facilities from the last financial crisis. You can see they started up in 2008, then they ramped up in 2009, and they were gone by 2010. So that part of what they were doing was just gone. But what happened is they started buying securities out. They started buying long-term treasury securities and mortgage-backed securities, and those went up a lot. And you can actually see in this graph, that's QE1, that's QE2, that's QE3. And then they were kind of flat for a while, and then they went down to 2019, and they were actually going up a little bit before that. What about reserves at the Federal Reserve, which gets more at the inflation question? And this comes back. I tried to convince Tom back in 2008 there wasn't going to be a lot of inflation, and it took a while. He learned at other places, but So these are excess reserves, and these are excess reserves before March 26, 2020, because that's when the required reserve ratio went to 0. And you can see, okay, excess reserves were pretty much 0, and then the Fed increased them, QE1, 2, and 3, and then they were reducing them, and then whoops, they start going up actually before the financial crisis. That's actually because what happened is that the Fed thought that it could reduce excess reserves, quite a bit more before the federal funds rate would go above the interest rate on excess reserves, and banks would actually worry about borrowing and lending reserves between themselves. This is the interest rate on excess reserves, T-bills and Fed funds. I use a 4-week Treasury bill rate, which is a shorter rate. And so you can see, here's the interest rate on excess reserves. And like Tom said, if you compare it to holding Treasury bills actually pay less. And that's true now too, even though the interest rate on reserves is 10 basis points. 4-week Treasury bills are paying 5 or 6. Not quite 0, but really, really close to it. This is the Fed funds rate. The Fed funds rate, which people in your grandfather's monetary policy think of as the interest rate the Fed really cares about, was actually an interest rate that was really paid to the GSEs, Fannie and Freddie, and federal home loan banks for their reserves at the Fed, because legally they're not allowed to receive the interest rate on excess reserves. So they would loan the reserves to banks, then banks would get the interest on the excess reserves, and they would pay most of it to the GSEs and the federal home loan banks. And so that's why it was below, because they had to pay them the transactions cost of fooling around. But then what happened is it went above. All right, in 2019, one interpretation of why it went above in 2019 was because banks wanted to hold the level of reserves that they were holding. They didn't want to hold less, and they were willing to borrow to hold what they did. I'll come back to that in a couple minutes. So this is the money stock. This goes back to 2000, so that you can see, well, here's the financial crisis. Not much of anything happened. And then, whoops, this is weekly data. Through May 11th, up we go. So it's up a lot. That's a big difference. And part of the question is whether that's a source of concern or not. Now, the first thing is, well, what's determining the money supply here? If reserves aren't determining, if we think about things, in terms of the multiplier and all of that stuff, what's determining the money supply? What's determining the nominal quantity of money here is how much money people want to hold. And that's basically determined by what they think their income is going to be. It's determined by what they think the inflation rate is going to be. Now, if you think about things, like when I go back to graduate school at Chicago with Friedman, that's kind of like the opposite. All right. You got the expected inflation rate is determining the growth rate of money, but that's a function of the way the Fed was operating during that period through the interest rate. And that's why you read all this stuff about forward guidance and why it might be important. And so the nominal quantity of money here is growing at this rate, and that basically reflects the 1% to 2% inflation that people more or less expected. So what's happening here? Well, what's happening here is the Fed programs and the $1,200 per person stimulus for most people, and the $600 a week unemployment checks on top of the old unemployment checks. And so there's a big increase in deposits in the economy. Whoops. Hit upon. So inflation hasn't really done much, and you can personally think the worries about deflation are overwrought. If you look at the personal consumption price index, less food and energy, in March, it went up 0.15%. I'm not going to annualize these because I don't think any of these things are going to go on for a year. In April, it went down 0.08%. Now, you can call that deflation if you want, but that's pretty tiny. So it's gone down a little bit, and then the question, of course, is, well, what's it going to do from here? Now, one response to all of this, this came up in a conversation with Paul, actually, is you might say, well, so far so good. And the question is where are you going? Now one possibility is, well, you're jumping out and there's a nice big mattress down there, like in the movies. On the other hand, there might be a sidewalk. So which is it? Or can we tell so far? So monetary policy so far has really been a lot different than it was in the past. Basically, what the Fed is doing is running a hedge fund, is one way to think about it. You may think that's a good idea or a bad idea. That's a different question. But basically, they're acquiring funds through reserves, and they pay interest on that, and that's a short-term interest rate. It's a daily rate. And they're using that to buy long-term treasury securities and mortgage-backed securities, both of which are long-term securities. And then it's been a very profitable business, actually, and they return quite a bit to the treasury in the process of doing that. The justification of doing it, of course, is well, it lowers long-term securities rates, and maybe firms will invest more, and then mortgage-backed securities supports the housing market. Personally, I think that's really dubious, but that's not really the question I'm addressing right now. The question I'm addressing right now is well, why might it not work so well in the future? And I think you get a clue from 2019. That is, you have this increase, they're decreasing reserves, and they plan to decrease them quite a lot more. And then here you get to the Fed funds rate goes above the interest rate on excess reserves, and banks are borrowing reserves and paying more than the interest rate on excess reserves to acquire them. Why would they do that? Well, one way of thinking about why they're paying is because for some reason they want to hold them. They're not just holding them to earn the interest rate on excess reserves, there's something else going on. And that's where you see what I showed you before, the interest rate on Fed funds going up above the interest rate on excess reserves. So the demand for reserves by banks was more than the Fed expected. This was a surprise. One explanation for it is what's called the liquidity coverage ratio. That is, banks are required to have liquid assets for a possible outflow for a year. Reserves at banks, reserves at central banks count as part of that. Very short-term treasury securities do too. And it's worth noting, if you look at the reserves that are held at the Fed, something on the order of 1/3 to 40% of those reserves are held by US branches of foreign banks. Why would that be? At first this sounds very puzzling. It's like, so Deutsche Bank has, I'm not saying they actually do because I haven't looked at their specific balance sheet, but you're just a commercial bank in a foreign country and you're going to hold reserves at the Fed. Why would you do that? Well, you would do it because the Fed pays interest on the reserves. The ECB charges. That is, the differential for a long time between the Fed and the ECB was 75 basis points per year. Now, there's foreign exchange risk for those banks to the extent they don't have dollar liabilities to match them associated with holding those reserves, but they're more attractive because at least you're getting paid something instead of getting charged. And so that's consistent with this liquidity coverage ratio story. That is, that banks wanted to hold the reserves because they're required to. Now, why didn't they hold so much reserves before? Well, this liquidity coverage ratio came into effect after the financial crisis, not before. It didn't exist. So how about going forward? The first thing to realize is, the demand for reserves, people talk about it as if banks will hold an arbitrarily large amount of reserves as long as it pays more than treasury bills. After all, it's like an arbitrage. A problem that banks run into is something called the leverage ratio. The leverage ratio is a limit on how much capital banks can have relative to their total assets. And the more they increase their assets, holding constant capital, then eventually they run into this limit they're running down to. And so what happens? Well, if you run into the leverage ratio by acquiring reserves, the only way you can acquire more reserves or want to acquire more reserves is you're going to have to issue more capital. You're going to have to issue stock. Now, most banks' cost of capital is more than the reserve ratio. On all of them, I'm quite sure. Now, is the Federal Reserve aware of this? That's actually is the interesting part. I think they are. That is, one of the things the Fed has done in the last month is there's a supplementary leverage ratio that applies to the very largest banks, basically systemically important financial institutions. They have to hold even more higher leverage ratio. And what the Fed has done is it's lowered it. Why would they do that? They were going to lower it actually for some institutions, and they expanded the set of institutions. Well, because they're worried that the banks are going to run into the leverage ratio. And then they're not going to want to hold the large amount of reserves that the Fed's going to issue. Now, there are other games the Fed could, there are other games that the Fed could play to make it work. But here's where we are. Okay, we have this big run up in long-term securities. And if we look in the last last month or so, there's a big increase from about $3 trillion, $3.5 trillion up to 5. And these are securities held outright. Liquidity facilities are a little bit of it, but not very much. It's the securities that are the big deal. And those are longer term. How much are reserves likely to increase? That's an important aspect of this whole question. If they're not going to increase very much, it doesn't really matter. Or if it's going to be very transitory. But the Fed says it's going to provide up to 2.3 trillion in loans to support US households, businesses, and communities. Plus, they're also going to purchase $500 million. All right, so they're up 1, roughly speaking. All right, so there's another 4 trillion total, so 3 trillion more. And on top of that, if you look at the Treasury's balance of the Fed, and this is from the Federal Reserve, it's the way they present it. The Treasury's balance at the Fed, which is a liability for the Fed, has gone up almost double in a very short period of time. If the Treasury writes a lot of checks, stimulus checks or whatever, paycheck protection, what happens? Well, this balance goes down and reserves goes up. And so that's an additional thing that contributes. The reserves are likely to go up by a substantial amount, not a trivial amount. So how's this all going to work out? And I don't have a lot of time, but so we clearly have an increase in the money stock. And this, unlike the long-term trend, is what economists call exogenous. It's determined somewhere else, basically Congress. They said, write a lot of checks to people and let them buy more things. The trouble with trying to buy more things is there are actually fewer of them. That is, a lot of companies are shut down. If you want to buy a webcam, I found out, tough luck for that. You can pay twice what you can buy one actually. You pay twice what you would have 6 months ago. There's big decreases in capacity. That is, how about airlines? Like Delta Airlines has made a promise, unlike some other airlines apparently, based on pictures, that they're going to cordon off the middle seat. They're not going to sell the middle seat. So you're not going to be fighting for the armrest with somebody that close to you. So what does that do? Well, that means they're going to have to charge more in the long run for a flight. There are fewer people flying on the flight. That is, there are fewer goods and services. If people are actually willing to spend as much as they did before, or even more, then prices are going to go up. So it's actually easy to see inflation increasing in the near term. Now, the counter argument to that is, oh, but output is lowered. Yeah, but it's not a recession either in that sense. It's that there are fewer goods and services available to buy. So how about longer term? Whoops. Sorry, this is a twitchy mouse. Will inflation's expectations stay anchored? That is, the growth rate of the money supply over the longer term has been determined by what people think inflation is going to be. And if people continue to expect inflation to be 2%, even if it goes up to 3 or 4% for a while, they think it's going to come down, then it'll come down, given the way the Fed is operating right now. Except if the leverage ratio or something else limits the amount of banks' reserves that banks want to hold, then the money supply is going to go up, and the relationship between the quantity of money and reserves that used to exist, while the magnitude will be different, will take hold again. Banks can't really change the amount of reserves that they hold in aggregate, but they can take actions that reduce their ratio of reserves to deposits. And how does that happen? Reserves don't change, deposits increase. And if that increases, then the nominal spending increases and inflation ensues. And so, yeah, that could happen. So the answer is, will it work out without inflation? Well, it can, but certainly not necessarily. So what I conclude is current monetary policy is really risky because we're sailing on uncharted waters. I've read a few people call it an experiment. It's like, wow, this is a massive experiment to be doing. And just on a final note, I can't really stop myself from saying this, is one way of thinking about current monetary policies is it looks an awful lot like what's called modern monetary theory. And traditional monetary economists like me have written things saying, well, that's all nonsense. And it actually is. But it sure looks a lot like it. So there's a lot of reason to worry. Thank you.
Well, thanks for that. Maybe a few questions. One thing that strikes me and has been a debate for some time, we say, the last time, 2008, 2000 through all the way through all the QEs and everything like that, the central bank didn't spark any inflation. And yet asset prices, went up tremendously. So and this time too, right? QEs, they buy up the bonds, they force asset prices up. Is there any work going on in rethinking the relationship between money supply and a different measure of inflation that somehow includes not just CPI inflation, but asset inflation too? I mean, is there, right now we want to interpret everything in terms of CPI inflation. And maybe we could start with Dick and saying, in the past wars, when we had these inflations, what do you remember what happened to asset prices? Do we have asset price inflation, in those previous instances, or they didn't exist? There were railroad bonds, there were other things like that. I mean,
I don't think in past wars that there was a lot of asset price inflation. Usually the government was borrowing most of the savings available. I think typically if you look at the stock market doesn't really like inflation. And so if in wartime you're having a lot of inflation, the stock market doesn't really do all that much. In connection with the Spanish flu 100 years ago, I kind of looked at what the stock market did in the US in wartime. And basically it was not very different in 1920 from what it was in 1917, even though it would probably the Dow index is what I was looking at, even though there had been 13, 14, 15% inflation a year. So the real returns to stocks were kind of low in wartime. But I think now, I mean, what's going on now, I think this really is different, and we ought to think about asset price inflation as being part of inflation. Because what I see going on now is, my colleagues described, the Fed is buying all kinds of bonds. And I'm thinking, what happens to the person who has his bonds taken away from him by the government? He sells them to the government. He's sitting there with cash. Well, where do you put your cash? And I think people are turning around with that cash and putting it especially into the stock market. And we see the stock market going up when, it must be puzzling to many people to say, how can you pull the rug out from under the economy and have the stock market go tearing up? I mean, it had one big fall, but it's back up to not very far off from where it was before the pandemic ever hit. So I really think this is, a different situation that we're in, because in most of the wars I've studied, asset prices didn't inflate.
Tom, Jerry?
Well, I would say here, they're very simple, that that asset prices, if we were looking at the stock market, for example, and bonds, those things go in a portfolio. If you're looking at what's happened to treasuries, the price of treasuries has risen tremendously, and the stock market's got to look like that too. Price earnings ratios have to rise if the alternative is these assets that are safe. So you're looking at 1 year treasuries yielding 0.17%. It doesn't take much earnings in a corporation for the stock to be worth that. And I think those two things have to move together in some sort of an equilibrium. Now, if everyone simply is scared, then they don't want to buy these uncertain assets. They want to buy certain assets, which they know the government. Some of the arguments for why before all of this, that European assets had negative values, and Phil Graham and I have talked a lot about this, is that Asia, they have all these developing countries have all this income everyone has. They're afraid to keep it in their country. And they're willing to pay the Germans or the Swiss to keep it for them, just like they would store their gold. They're willing to actually pay them to do that because they can't keep it in their own country because it's not safe. They can invest it in capital here, the safest country in the world to own capital, but also they can just make sure that 10 years from now, they'll have a bond from Germany that they'll know what the Deutschmarks are worth, even though they're going to pay 5% less. They're going to get 5% less than they're paying them now. But 10 years from now, Germany will still be there and their government might not be. And I think it's a very important characteristic that's going on.
Thanks for that. And before I let you jump in, Jerry, he just had a perfect setup here. And in the US, we have one political party talking about a wealth tax. So how safe is capital in the US facing a wealth tax and markets and with asset price inflation? Could this have an impact on what happens to the outlook?
Yeah, I'm not sure how much faith I put in journalists, but what I remember is when Elizabeth Warren dropped out of the presidential race, stock prices went up. And I think when Sanders dropped out, they went up too.
Yeah, but Joe Biden has been talking about a wealth tax out of his basement.
Yeah, well, I think that's a question of going forward to the election. If it looks like he might win, then stock prices will start going down.
Yeah, but then what happens to all the reserve? I mean, if nobody wants to take their liquidity and buy stocks anymore, where does it go? Where does all this extra liquidity go that was created if it's not stocks and bonds anymore? If we get afraid of holding those?
Well, the reserves are an asset to the bank. And so probably people would actually want to hold more. I mean, one way of thinking about it is that the interest rate on excess reserves under the current setup basically sets the risk-free interest rate for the economy. And so nominally risk-free. I mean, not in real terms. And so to the extent that people start worrying about a wealth tax actually being possible, then the demand for reserves, if anything, would go up, and the demand for deposits at banks even.
Those are the easiest things to see in tax, Jerry. Why wouldn't you want to hold some kind of real property where nobody knows you own it?
Oh, well, I was thinking about general uncertainty before the election. Yeah. Well, how would you avoid a wealth tax? The easiest way is to spend it.
And what is that? What is that?
You know?
What does that cause?
I mean, that is the easiest way to avoid it, right?
Yeah, sure.
And it goes back to the inflation in the 70s. It's like, well, you can buy a really nice old car, and then the question is how much to value it for, and you pay somebody a lot of money to say, oh, it's really not worth very much. And it's not going up in value either, and it actually is. You'd obviously open market assets like stocks and bonds would become much less valuable if you're going to be taxed on them at the end of the year. I mean, there are states that have personal property taxes, which are pretty much not enforced, but what do they end up really in taxing? They end up valuing stock portfolios, bond portfolios, and bank accounts, because those are easy to trace. How much furniture you have is pretty hard to trace, or how much it's worth. And that's very hard to tax.
Dick,
I guess you could just shift your assets out of the country.
Well, I would say we're missing one point that's very important, that we're kind of considering what are the prospects for inflation. And all the books, these Ec1 books and all the other books say that inflation is good for debtors because they'll probably get more money in their pay packets and it'll be easier to pay off the mortgage or the auto loan or whatever. And so inflation is good for debtors. It's bad for creditors, just like wealth taxes, I suppose. And we should remember when we're thinking about the outlook for inflation, who's the biggest debtor of all? And that's the government. And I can sort of see, if what some of us are suggesting is that maybe there's a little bit of inflation in front of us, I can see when it starts, they'll say, well, the Fed is making up for lost time or lost inflation. It didn't quite get to 2%. So why don't we have 3 or 4% for a while? and make up for the lost inflation we didn't have before 2020. And then, it'll actually dawn on some people that the government, you remember when there was bracket creep back in the 1970s. People had to pay higher taxes with their inflated salaries, but they weren't real gains in income. I think the same thing could well happen again, where we're sort of told that it makes it easier for the government to handle its debt if we have a little bit of inflation. So we haven't thought this way for 30 or 40 years now, but history shows that instances like that happen a lot. And so I worry a little bit that at some point the government officials will say, well, there are really some good aspects of the inflation.
It's only unanticipated inflation that does that, though.
Right. I mean,
inflation doesn't.
If the bond vigilantes come out and do what they did in the 1970s, it'll very much complicate the the Fed's policies, as it did until Mr. Volcker came in and got
The real
inflation
returns on U.S. bonds, actually, I think were pretty much negative during that whole inflationary episode. That people kept being surprised by how high inflation was, and then that there'd be a recession and it would go down a little bit, and then it would go up higher than it was before. And right now people are expecting, depending on who you talk to, somewhere between 0 and 2% inflation. So if you can jack it up to 4, I mean, you've reduced your liabilities significantly. I mean, the government. I mean, I do think that's a motive for inflating in the future, for sure.
But why is the public so anchored on the belief that the Fed can control the inflation rate to 2%? And you mentioned this forward guidance where, okay, we're going to catch up, we're going to go to 4%, but trust us, we can bring it back down to 2. I mean, there's no evidence I'm aware of in the last 20 years where the Fed can ever hit its target. I mean, on these things, it's entirely luck, in my opinion, where it comes out half the time. So, I mean, why would the public accept this? Yeah, we're going to go to 4, we're going to go to 6 and catch up, but we'll be back to 2 in no time at all. I mean, are we that gullible, or
I don't think they would.
I'm just dumb, maybe.
Yeah, no, I don't think people would.
Well, the other issue is that the Fed's been wanting 2% inflation. It's all the central banks have. We haven't had it at all. And so why would they suddenly believe that if we're going to have this inflation? I mean, the fact of the matter are that since 2008, the goal of the Fed and all the central banks, if you read their goal, it looks like one of them wrote it and they translated it into their language. It's exactly the same, at least when you translate it back into English from the Japanese. All the central banks have the same goal. None of them has succeeded in reaching it. So why would the public believe suddenly that what they say is now going to suddenly be true?
I agree. Jerry, I wanted to come back to a point that you made, and I think it's very important when we look at the excess reserve balances and the size of them. And it's the foreign branch bank share of that, which is quite large, 30, 40%. And you mentioned that's because the ECB charges them on reserves, but it's even worse than that. All the short-term safe securities in Europe and Japan are paying negative rates. So the Fed is the only source of sort of safe short-term positive money. And with central banks, with Japan doing what it's doing, the ECB doing what it's doing, does this pressure of the Fed becoming the depository for the world, basically, is this increase? And this of course robs the Treasury eventually. We're paying foreign banks interest on excess reserves, and we're not paying a lot right now. We're down close to 0. But I mean, does this eventually become a problem for what we're looking at in the aggregates, how we think about things? I mean, domestic inflation versus, the size of the reserves in the system when they're not reserves that are going to, increase the money supply domestically. How do we want to, revise our thinking on that?
I think as long as the interest rate on excess reserves is less than, say, interest rates on a fair number of Treasury securities, arguably it's still a profitable thing for the Fed to be doing. It's, on an income statement set up. And that's the issue. Trying to think about the issue isn't really I'm lost track. The issue you were raising?
Well, we look at the size of excess reserves and we say, oh, they're gigantic. And then, but 40% of them aren't in domestic, going to be used domestically. They're not, these banks don't have customer deposits in the US. They're all, for the most part, corporate, only corporate banking here, but they can have accounts at the Fed and hold reserves there. So have we lost the relationship between, is the whole relationship between excess reserves and the money supply, different forever on account of this sort of thing?
Yeah, well, I wouldn't say forever, but it's definitely different now. I agree with that. I know that's what you really meant to say.
Yeah.
Is, it does create a big difference because, like you say, they're holding these reserves, and to them, it's really no different than holding treasury bills or something else. It has nothing to do with deposits. It's just an investment, and it's better than the ECB. The reason I got lost is that one of the interesting things about it is the Fed has been very adamant about not lowering the interest rate to negative levels. Because what would happen if the Fed said, well, we're going to charge minus 1% a year for reserves? Well, that would be worse than the ECB. And so these foreign branches, these US branches of foreign banks, no, they wouldn't want to hold them anymore.
Well, they'd have to do something with their reserves. Buy treasury securities, do what? It would force treasury securities negative if they bought treasury securities, the prices.
Yeah. Well, if you're a foreign bank, what would you do? You'd buy something like treasury securities and then, or you just, you'd just buy treasury securities and then you'd sell those and transfer the funds back to Germany.
You'd end up driving treasury securities negative in the US too.
Yeah.
Just
Oh,
like,
yeah. No.
Yeah.
Well, it's for sure. It's true that if interest
Yeah.
rate on excess reserves was negative, treasury bills would have negative interest rates. I mean, that's why they have negative interest rates on short-term government securities in Europe.
Sure. Dick, do you want to say something?
Well, I think what you guys have been talking about is kind of dancing around the idea that the Federal Reserve has actually become like the world central bank. It's not just our central bank. There's a big demand for dollars out there in the world. Today we've been leaning toward we should worry a little bit about inflation, but one of the arguments I read about why we should be concerned about deflation is that there's a tremendous demand for dollars there in the world, and so that when the Fed creates all these new dollars, there are people willing to hold them, and we touched on that a little bit when we said there's a demand for holding dollars. So I think the Fed has become like a world central bank, and there is a demand for dollars, but I don't think it will go on forever, and that's why I think we should worry a little bit about an inflation outlook, because back in the 70s, the Fed behaved a little irresponsibly, and the rest of the world lost confidence in the dollar, and it could happen again. We seem to have a lot of faith in what the Fed can do, but I still worry that a little bit of inflation, or maybe even a good bit of inflation, eases the burden of the government debt. We're running up the government debt hugely now, and people are going to say, well, why don't we ease the burden of that debt a little bit? A little inflation might not be a bad thing.
But we are the biggest economy in the world.
Yes.
Yeah.
Are we getting any questions from our listeners?
We have one. It's for Thomas, Professor Savings. You made a reference to the Fed increasing the supply of currency. By currency, do you mean actual paper currency held by the public, or do you mean balances that banks have on deposit at the Fed?
Well, I mean liquidity, not really currency, because the currency hasn't really gone up at all. It's not currency, it's liquidity. So it's the guaranteed right to have currency if you wanted it. And that's really what we mean when we're talking about wanting liquidity. And liquidity is not, for example, if you can't get your money from the money market fund immediately, and remember in 2008 you couldn't, they would have sent, I remember getting a notice from one of them saying, if I wanted more than 25,000, I would have to wait a month to get it. And if that's not the way they operated, and that's why the Federal Reserve had to go into the commercial paper market, because all of the money market funds were trying to get rid of commercial paper because everyone wanted cash in a sense, but they were going to make it at somewhere where they knew it was safe, and they were worried about these money market funds where everything depended on commercial paper, and the Federal Reserve went heavily into commercial paper, just as they've done this time. So the same thing must be happening at these commercial paper. When you have all this uncertainty, the best thing you can have is real liquidity. You don't want to put it under your mattress, but you want to have the equivalent of it. And if they're going to make you wait 30 days to get your money, that's not cash. And I think that's the issue that I was really raising. Not that they were, because the amount of currency is really not changed very little over the past 20 years.
Does anybody have any final words they want to add here? Not today. Okay.
Well, I might just say that, you know, I was a little bit shocked when I saw these monetary aggregate statistics that have come out recently. Tom Saving referred to them as well, that, you know, we're seeing rates of money growth, you know, year over year right now of somewhere between 15 and 30%, or 29.9%, I think it was the money growth of M1 year over year. So, and, you know, we haven't seen money growth like that for a long time. And it seems like, you know, there ought to be alarm bells going off, but, you know, when I pick up Business Week, they're talking about worrying about deflation. So I think, you know, am I right that economists haven't really paid much attention to monetary aggregates for some years? And maybe we should pay a little more attention to them.
I don't think that's right, but I think that right now in this kind of circumstances that you saw in 2008, these increases are really increases in, you look at the underlying data, are increases in checkable deposits and not currency. And they went away in 2008. Once the crisis is over, they'll go away. And I think that's true. This is not a continual change. This is a monetary crisis, which we're in, not because like the last time with mortgage-backed securities and that market disappearing, but here you've shut the economy down and people are panicked. And panic makes people want safe securities. And I think that's what we've done. We created a panic. Now, we didn't create COVID-19, but we created the economic cost of it.
So you're saying essentially there's been a huge increase in the demand for money, and the Fed is just responding to that with a huge increase in supply.
Exactly.
Yeah, I would disagree with that. I'd beg to differ with Tom. Is that this big increase in deposits reflects a lot of transfers from the government to households over a very short period of time. And at the same time, they tell people, no, you have to stay home. You can't go out. All right. And I've read where people have commented, oh, they're spending less because they're home all the time. They can't spend enough at Amazon. But these lockdowns are going away and those balances are there. And the increases that we're seeing now, like in the graph, are much bigger than they were in the financial crisis. And they're coming, it's a combination of things. I mean, you have to remember, you know, people don't talk about it much, but like one graduate student was telling me, several of his friends are just staying home playing video games all the time because they can't do anything else. But they're making more money than they ever made while they were working. And so they're just accumulating these balances. And it's not like, you know, these are people who are like 22 years old. It's not like, oh, they're going to hang on to them forever, or they're going to take them and go buy stocks or bonds or something else. No, they're going to get a new video game machine. They're going to go out and buy stuff. And the trouble is with the lockdowns and then the consequences of the various restrictions that are going forward, there's not going to be as much stuff to buy. And so what do you get when you put those two things together? Prices have to rise.
Well, I would ask though, Jerry, why is the commercial paper market having all this trouble and the Fed has to come into it? They have to come into it because individuals would like to get real checkable deposits instead of money market funds. And that's what's causing the commercial paper. So they've gone into these other markets, of course. And of course, there's the big market that's the one that's like mortgage-backed securities or asset-backed securities, which are a much bigger market than mortgage-backed securities.
Right.
And
Oh,
they have a
Well, and the
facility.
Fed has expanded
Yeah,
into asset backed.
that's right.
so I'm going to have to cut the show short. We're about to run out of time here. I want to thank all three of you very much for agreeing to do the podcast. I think it's very interesting. I didn't get time to play my music at the end, my little song, but we'll just have to live with that. So anyway, Dick, Tom, Jerry, thank you very much. Thank you for your thoughts on this. I think there's probably a lot more we could meet and talk about in the coming months. So let's keep in touch.
Thank you, Paul.
All right.
Yeah. Thanks a lot, Paul.